And what I'm going to do is take Wayne's question from earlier. I'm going to put that in the room right now because that is how we're going to start this conversation. So I just put this up here right now. Mike, let me know when you're ready with the recorder. All right. Okay. So when referring to option volatility, we look at implied volatility. Okay, implied volatility is the option volatility. In Wayne's question statement from earlier this morning, he referred to HV. HV stands for historical volatility, which tracks the volatility of the stock itself, not the options. So let's get a whiteboard up here. Let's clear. Wish we could get more than 10 up here. Mike, maybe that's something we could talk to Omnovia about to see if we can get more than 10 white pages up here. Okay. Implied volatility versus historical volatility. Okay. So again, implied vol, and when I reference this now, I'm just going to use IV equals option volatility, where HV, historical volatility, equals stock volatility. Okay. Typically, and we'll pull up any chart that we can here, and let's really stay with YUM. The shape and movement of option volatility, and just think about this in its easiest sense, is going to follow the same pattern, typically, of the stock volatility. Okay, so the email said GS is an iron condor spread. Hang on, sorry guys. Adrian, let me check that. Okay, yeah, we will correct that. It is just a put spread, and I believe there was a clarification sent out on that. Okay, so anyway, it makes sense, right? Stock's more volatile, then the options have to be more volatile because the options are a reflection of how the stock is trading, and vice versa. If the stock is really quiet, not moving around, this, that, and the other, then the option premium, option volatility, implied volatility is going to be tame as well. So on this chart right here, and let's just make this volatility chart. On here, okay, the blue line which I just added is actually historical, the stock volatility. The option volatility, implied volatility, I have two of them up here, but I'm actually going to take out the 30-day and just put up the, whoop, I didn't want to do that. There we go. Just the 60-day, which is in yellow. There we go. So the blue is stock volatility, 60-day stock volatility. The yellow is implied volatility, 60-day option volatility. And you can pull up just about any chart you want, any stock, and I'll come back to YUM in a second since that's what we're going to focus on. But let me pull up Goldman Sachs really quickly here. Do the same thing. And you can see the blue is the historical stock volatility, 60-day vol, and the shape, the dynamic of the implied volatility is the same. Okay, so I don't want to beat a dead horse with this one, but just suffice it to say that implied volatility will trend historical volatility. Okay, so let's get back to Yum now. So Wayne's question, oh shoot, Mike, we never put out the Yum stop. Do you want to get that out there while I'm talking? We had decided we were going to put a stop exit order out there in Yum on our put spread. So we'll get that up in the room here. Okay, it's not anywhere close to the stop right now, but we just want to have that out there. If for some reason this thing rallies, we don't want to get caught with our pants down. So anyway, implied vol measures the market estimate of a particular stock's movement or range over the next year with 67% certainty, which in mathematics terms and statistical terms is called one standard deviation. Okay, so you guys all with me? Just want to make sure you're all listening and you're all with me. Okay, cool. Go back here to Yum, and let's get our stock and volatility charts up here. Okay, so Wayne's question was with implied volatility in Yum trading 34, I believe it was. Let's see, 34.1. He had actually said historical vol, but we're gonna go with implied vol there, trading 34, and the price is 76, which it's right there. So that is absolutely we're gonna round that off. Does that mean the price swings between 101.99 and 50? And what that 34 means, when we look at, let's look at the at-the-money regular October. Of course, I'm having some technical difficulties here. Hey guys, is your screen, are your screens working? Can you see Yum? Is Yum up on your screens right now with all the October 2nd options? I want to make sure that the screens are refreshing properly. Okay, cool. Hey, cool. Everybody's got that. So then it's just my screen that needs to be refreshed. If you scroll down to the regular October 16th expirations, a regular October expiration in Yum, And let's look at the at-the-money option, the 76 strike we can look at. And just bear with me here 1 second, guys. I'm going to refresh my screen. Okay, I'm back on now, but I am definitely having issues on my end. Not good. Not good. Hey, Mike. Sorry, guys, for this interruption. I am unable. Oh, maybe there we come on. Maybe. No. Okay. Yeah, I think you know what. I think we're gonna refresh the room here, guys. Just hang with us here. It's not just me. It's we're gonna refresh the room. Hang with us here 1 sec. Really sorry.
All right, guys, let me get this the video up here. Maybe this will make things smoother for everybody. One moment. All right. That should be good.
All right, let's. There we go. Okay, there we go. Okay, now we should all be good to go. At least I am. So hopefully all you guys are. Okay. So in the middle of your screen now, you should see my cursor moving, and I'm right here at the 76 strike. Everybody good with that? Yeah, everybody besides Wayne, you can all see that now. Your screens are all up to date. Anyone? Can you guys hear me? Okay, Wayne, Tom. Okay, here we go. Okay, cool. So we look at the 76 strike, and right now we can see this implied vol is 44. Okay. So Wayne had asked about 34 earlier, but it's actually trading 44 now. So what does that actually mean? Let's go back to our whiteboard. With an implied vol of 44, this means if we take our current stock price of 76, okay, multiply that by 44%, or 0.44, okay, that equals 33.44. Okay, so that means the market, this means the market is currently pricing a move of $33.44 either direction within 1 year with a 67% certainty, or 1 standard deviation. So that means if everything stayed the same from now, today, For 1 year, volatility stayed the same. Everything stayed the same. The market is predicting that Yum could trade in a range of 43 all the way up to roughly 109. Does that make sense? Yeah, exactly. Wayne, you got it. You did the math there. Okay. Does that make sense? It's just a simple mathematical calculation. So that's what that implied volatility number means. So now, the next part of Wayne's question was, back in his, and let's scroll back here. Using a 34% implied volatility at the time, that meant a range of 50 to 102. Yet in the past year, the stock has never hit either of those prices. Absolutely right. And why do you think that is? Look at this chart here, and why do you think that is? Why would the stock have not traded out to those outer edges? Anyone? Not less than HV, Wayne, but you're kind of on the right path. Anyone else? Come on, why wouldn't we have gotten to those ranges that Wayne was talking about, or the range that I put on here using a 44 vol of this 43 or 109? Why wouldn't we have gotten there? And again, this is a predictor going forward. It doesn't look in the past. But even so, how come we never got close to those ranges? No, they definitely did not miscalculate HV, Wayne. No. Again, look at, I'm going to give you guys a hint. And let's take out the HV line so we only have the implied vol. Okay? This is our historical implied volatility chart. What do you guys think over time, over the year that this is showing here, what would you approximate the average implied volatility? There you go, Charles. Charles is right on target. Okay, if I looked at this, both Charles, I like what both Charles have said now. If I look at this here, I'm going to say, I could be off a point or two here, but would you guys say that the line I've drawn here around 26 is probably closer to the average over time? I mean, we've seen it down as low as right here, 18, as high as 42. But if I had to draw, the median across the board here, average across the board, I'd say 24 or 25. Ed, what do you mean Yum is gaining? Unless I'm looking at something incorrectly, it's down 10 cents on the day. Am I looking at something incorrectly, guys? And we put out a stop order, which you should have in there. Okay. Okay, do you guys all agree with me? If I had to, just ballpark an average here, I could take 24, 25, whatever, you want to look at. I'm talking about implied volatilities. Okay, let's use 25. Okay, so let's recalculate 76 times 25% is 19. So over the last year, historically, over time, the real movement in the stock based on the average, the average implied volatility would actually be 57 to 95. Not this 43 to 109, which we never saw, but 57 to 95. If we go back here, here's our 1-year chart. Okay. 1-year chart, we see a low of 66, a high of 95. Right on target, right, with almost how this has traded over the last year. So implied volatility, when it's heightened, when it's increased like it is right now, all that tells us is that if implied vol stayed at this range for the next year, the new projected range of the stock would be this. And this just proves out higher vol, bigger range in the stock, lower vol, lower range in the stock. Makes perfect sense, right? So you can look at that with any stock you want to look at. And we could see the same exact thing. If you guys want to go through one more example, I'd be happy to go through one more example to prove out the exact same methodology that we just did. Somebody throw out a stock that, we all kind of know that we've been looking at. Hey, GS it is. GS, let's look at the 170 strike as being at the money here. Okay, 170 strike, trading about a 36 volatility, 36 and a half, but I just want to round it off. Okay. Wayne, let's do this, and then I'll get back to that. Okay, so in Goldman Sachs here, we're using a 36 vol, but let's look over the last year here. What would you say the average, the median has been in Goldman Sachs over the last year? I'd say look up, and it's probably more around 20 to 21. Would you guys agree with that? Okay. So let's go back to our whiteboard here. Let's go on a new one here. Hello? Hey, sorry guys. Okay, so Goldman Sachs trading, what are we, 171. And come on, why are you not doing this for me? There we go. And current IV is 36. Versus normal IV, normal IV of 21. So just doing the math, if I take 171 times 36%, that gives me $61.50, or a move, or a range, I should say, of 109.50 up to 232.50. Okay, so the current marketplace, because of the heightened volatility, is saying that if Goldman Sachs continues to trade at this 36 implied volatility, this is the projected range for the next year in the stock. Whereas, if we use the average volatility, the most likely volatility, that move decreases to a projected 36, I'm rounding off, $36 move, or a range of 135 to 207. Okay? Well, let's go back here. Where has Goldman traded over the last year? 1 year. It's trading actually at its low right now. Okay? 165 up to 219. A lot closer than what the heightened volatility measured. Okay? So that is what implied volatility means. Again, it's forward looking. It's not backwards looking, it's forward looking. And that's why when you see Mike and I going through signals and we're always adjusting volatilities, we want to adjust volatilities to where we believe the norm is. Remember, reversion to the mean. What is typical? Where do we believe volatilities are going to be? And the best indicator is, what we can look at historically. So that's why you always see us adjusting volatilities when we have signals out there, because we don't want to price something out when it's trading, away from its mean. We want to see what something should be, quote unquote, theoretically worth when it's trading at its mean, and then try and capture any arb or any differences there. Yes, it would, Connie. It'll tighten it up a little bit, but yeah, it'll be, because if I put IV30 here, look how close they are to one another, and you can do that for any stock. Let's go. Here's Yum. Okay. I'll pick a random stock here. Here's FedEx. I just clicked it because it's right there. There's the difference. No, it's not our proprietary approach at all. This is, this is there's nuances to what we do with this information. This information is not anything that we made up. Okay. This is information that is just out there in the mathematical and option world. And when Ed, you ask who calculates implied volatility, well, the market does, and the Black-Scholes model does. And premiums are, volatility gets more expensive when there's panic, when there's nervousness, and gets less expensive when things are calmer. And that's where you see the variances and deviations, right? Look at this happens to be the FedEx chart up here. So this is the day that the market just completely crapped out. Last in August, that day that the shit hit the fan. Excuse my language. Okay. Well, look what happened here on this day. Here's the stock. Here's what FedEx did in the stock. Took this dump all the way down, and look what happened on implied vol on that one day. Right? Wayne, I can't tell you how Options Express came up with that, and maybe it was implied vol and not historical vol. I can't. You can call them and ask them. I can't answer that. And Santos, thanks for that answer. Difference between IV30 and IV60, exactly what it is. This is a trailing. Where has vol been? Taking in the average of a 30-day moving average versus a 60-day moving average. So if you're looking longer term, you use the 60-day. If you're looking shorter term, you use the 30-day. And we can even use 90, 120. As you go out further and further, you're going to see more disparity between the short term versus the long term. All right. So Wayne, great question this morning. Or Ed, great question this morning to get this started. I think we've beaten this up pretty good. And now Mike and I are going to get back to hopefully some signal calling here. Hopefully as good as Aaron Rodgers did last night. All right.